for silver. Let's say silver is going to outperform gold as gold makes its way to $10,000 or $15,000 an ounce. That's a big number for silver. We're talking a couple of $100 an ounce there, if not more. And I wouldn't just flat out predict $200 silver anytime soon. But when markets get crazy, sometimes things go parabolic. And I think silver is a candidate for something like that. So it's not cheap anymore. It's we're one good day away from $40 an ounce right now, which is only $10 off the all-time high for silver. But I think those previous all-time highs are not going to be very much resistance once things get going. I think they'll blow right through $50 an ounce.
Silver pulled back slightly on Friday, pausing just under the $40 mark, a level that's more than just technical resistance. It's psychological. The market hasn't convincingly broken above that zone in over a decade, and while momentum has been building, traders are hesitant. Crossing $40 would likely trigger a surge in buying, but for now, the rally has lost some steam. JohnRubino, founder of the Dollar Collapse site, puts it into perspective. Silver is a small, thinly traded market. It doesn't take massive inflows to send prices flying. Once silver catches a bid, it can rip through resistance levels, like $50, with barely a pause. And if the current move is tied to broader shifts, such as a global currency reset, this bull run could extend far beyond what most are prepared for. But markets don't move in straight lines. Gold and silver bulls have seen this before. Another rally, another fade. Gold, for the fourth time, made a push toward $3,400 only to fall short again. These repeated failures are frustrating investors, despite the macroeconomic case for higher prices being arguably stronger than ever. Physical demand might soften a bit at higher prices, but that's not the story right now. With central banks still buying aggressively, inflation risks lingering, and geopolitical tension refusing to calm down, the ingredients for another leg higher are all there. Many analysts still see a path to record highs before the end of the year. Rubino isn't afraid to think big. Suppose gold does shoot toward $10,000 or $15,000. Silver at $200 stops sounding like fantasy. It's not a sure thing, but in a world that can go parabolic under pressure, it's a scenario worth considering. Even now, silver isn't cheap in the strictest sense, but Rubino still sees opportunity. It's hovering close to a breakout zone, and it wouldn't take much to light the match. With $49 still standing as the all-time high from 2011, there's not a lot of overhead once silver clears $40 and finds its legs again. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, a monetary reset is the natural outcome of a currency crisis if we have that. So that's in our future too. It comes, in the natural course of things, it will come after the Fed messes up the yield curve and the dollar tanks, and then something like a new gold standard becomes the least bad option on a list of really bad options, because the government doesn't want to give away the power to create money out of thin air. But that might be the least horrifying thing that they're staring at. So that might happen. But then Trump has some gold bugs in his circle. So let's say he takes a couple of them, puts them on the Fed, and the Treasury Secretary is apparently a big owner of gold. And maybe they just pull a new gold standard into the present. Don't wait for a crisis to force it, and they just announce something like that. That's, on the list of quote unquote crazy things that Trump has done in the last 6 or 8 months. I don't think that's number one. It's something that it is now conceivable that one day we just wake up and we're on a new gold standard. So, sooner the better, as far as I'm concerned. It's doing something like that means, by definition, to dramatically devalue the dollar. And that's what you have to do for today's amount of gold to back a currency where there's so much of it out there as with the dollar. And that's terrible for people who trust the government. Like if you've got a big treasury bond fund in your IRA, or you've got a bunch of cash under the mattress, or you've got a bunch of bank stocks or something, and anything like that, where they depend for their value on the value of the currency, and we devalue the currency by 3/4 or whatever it takes, those people who trusted the government get screwed over. And they're really the least deserving of that kind of a fate. And when it happens, it'll cause a lot of civil unrest. So we got to get through the rebellion of the people who saw their nest eggs just melt away before we actually have a stable monetary system that will be zero inflation going forward. So again, chaotic times coming. The sequence of events is impossible to predict, but the big wild things that flow from pretty much any option right now in terms of policy are out there just waiting to happen. Well, in a precious metals bull market, normally that's what happens. Gold gets the initial bid, because that's the name everybody knows, and that's what they associate with inflation hedges and currency resets and things like that. And so gold goes up first. Silver lags. The gold to silver ratio, which is how many silver ounces it takes to buy an ounce of gold, goes up into the 90s, sometimes touches 100. And then at that point, silver looks so cheap to the people who have made a bunch of money in gold that they start switching over and they start buying silver. Silver is a tiny little thinly traded market, and just a little bit of money flowing in from outside into that market sends the price up dramatically, and it outperforms gold for the last couple of years of the precious metals bull market. Now, we're in a unique precious metals bull market in the sense that it might be leading up to a currency reset that gives us a gold standard, So it could be that it's not just a couple of years from now that this thing has to run. It could be that it runs longer and stronger than previous precious metals bull markets, which means for silver, let's say silver is going to outperform gold as gold makes its way to $10,000 or $15,000 an ounce. That's a big number for silver. We're talking a couple of $100 an ounce there, if not more. And I wouldn't just flat out predict $200 silver anytime soon. But when markets get crazy, sometimes things go parabolic. And I think silver is a candidate for something like that. So it's not cheap anymore. It's we're one good day away from $40 an ounce right now, which is only $10 off the all-time high for silver. But I think those previous all-time highs are not going to be very much resistance once things get going. I think they'll blow right through $50 an ounce, and then who knows? So silver is still a buy at this price. It was a better buy at 24, but it's still a buy. The silver mining stocks, by and large, still look good. So I think the silver story is intact, and the big final run is still out there waiting to happen. So if you haven't missed the boat, if you're not all in on silver right now, in other words, if your stack is paltry, you still have time. But and I'm not selling anything yet. It's going to be hard to figure out at what price we should start lightening up. That's a subject for another show. But will 50 be where we need to start handing off some of our silver to the new money coming in? I think maybe not. I think we might just be long and strong into some much bigger numbers. A crack-up boom is where it becomes clear to a critical mass of people that it's the government's explicit policy to devalue the currency going forward. And they just give up on the currency. And by giving up, I mean they convert their dollars or euros or yen into real stuff like oil wells and cattle farms and gold and silver. And that sends the price of those things through the roof, and that's inflation, right? When the prices of a bunch of things just go straight up, that's borderline hyperinflation. And then the currency collapses and we get the monetary reset. So I think a crack-up boom is basically the mechanism by which most of this stuff happens. So I would say, it's highly, not just possible, but highly probable that something like that happens in the next 3 to 5 years.
John Rubino makes a sharp point. If the long-expected recession finally lands, the Federal Reserve could be forced to cut rates hard by as much as 5 percentage points. That would push the Fed funds rate down to 0 or even into negative territory. But here's the catch. Dropping short-term rates doesn't mean long-term yields will follow suit. If inflation expectations remain elevated or bond markets start factoring in rising fiscal risk, longer-term yields could remain stable or even increase. That possibility puts recent developments between the White House and the Fed under a sharper lens. President Donald Trump stated on Friday that his meeting with Federal Reserve Chair Jerome Powell was successful. It wasn't a typical policy discussion. It happened during Trump's visit to the Fed's headquarters to check in on a costly renovation project. However, Trump walked away, suggesting that Powell might be open to a rate cut. For now, the Fed hasn't made a move. Most analysts expect it to hold its benchmark rate steady in the 4.25% to 4.50% range when the policy meeting concludes next week. Powell has stuck to the script, saying the Fed needs more data before shifting course. But the pressure is building, politically and economically. If the downturn arrives faster than expected, and if inflation refuses to roll over cleanly, the Fed may find itself caught between a need to stimulate and a market that won't play along. That's the kind of scenario that can shake confidence in fiat policy and push investors toward tangible assets. Let's get back to the interview.
This is something you very seldom see because the governments always try to bully their central bankers, but they do it behind closed doors. Trump is doing it; he's tweeting it, and so it's that's a completely different environment for monetary policy to take place in. But okay, two things with this. One is Trump is an easy money guy, and he always has been because he's a real estate developer, and cheap money is the lifeblood of real estate. The lower the interest rate on your capital, the more you can do with it. So for him, low interest rates are an unalloyed great thing, and he wants that from the Fed, and he's not shy about demanding it. The other thing is he will get what he wants eventually because either he browbeats Chairman Powell until he just quits and Trump replaces him with somebody who's a 0% interest aficionado, or Powell stays out his term, but it's really contentious, and he feels a lot of pressure to ease, and maybe goes ahead and does it while he's in office. Either way, Trump gets lower interest rates by the end of his term. Or the other thing that could happen too is that we have that recession finally that has been looming out there for such a long time, and the equities bear market that goes with it, and that normally causes the Fed to cut interest rates by about 5 basis points, or I'm sorry, 500 basis points or 5 percentage points. So that would take us down to zero and a little below on the Fed funds rate. Then the question is, what is the bond market going to do with suddenly dramatically lower interest rates in the U.S.?
Right.
I don't think it's clear because normally the Fed has the power to manipulate yield curves if it wants to, because it can buy long-term bonds, force the price down if it wants to, and we'll see, or force the price up and force interest rates down. So we'll see if the government tries to do that, whether they can succeed, because right now, who in their right mind would lend money to a country with government debt 120% of GDP and interest costs on that debt at $1.5 trillion and rising because we're borrowing that interest? So each year the deficit gets much bigger. So I would think the bond market would be pretty skittish if we lower interest rates dramatically at the short end of the spectrum and then try to bully the bond traders. And it could be that we get the opposite of what Trump wants, which is, he gets higher interest rates instead of lower, which is basically what happened when the Fed started easing last September. They cut the Fed funds rate, but the 10-year Treasury yield went up from there. And that was just a half a point total cut in short-term interest rates. So let them try for something more serious. And you could get a commensurately larger increase in long-term interest rates. So anyhow, the short answer is that who really knows? There's probably financial chaos coming in all of this because we just don't know, first of all, what Trump gets and when, and what the bond markets do in reaction to those lower interest rates. So I think this is a very dangerous time for being long bonds, put it that way, because I think that's a market with a lot of embedded risk, and we just don't know how that's going to play out. The bond markets don't cooperate, and we get higher long-term interest rates. That's massively deflationary. So governments, at least recently in the last 10 or 15 years, have responded to stuff like that with an aggressive attack on long-term interest rates. In other words, you create a bunch of new currency, you buy a bunch of bonds, and that raises their price, lowers their yield. So you get lower long-term rates. if they try that again, that might work, or it might spook the bond markets even further. And then you get chaos when bond traders say, "Oh no, I'm not going to buy bonds at this interest rate. I need a much higher yield." So I'm waiting for 7% on the 10-year, something like that, and that would cause chaos. And the government would have to step in and try more aggressively to push interest rates down and liquefy the system. And then you get the pressure on the currency at that point. So who wants to own the currency of a country that has 120% debt to GDP, massive interest on that debt, and is actively trying to inflate away that debt? You really don't want to own the currency of a country that's doing that. So it could be that we finally get that dollar crisis the next time the federal government tries to manipulate the yield curve. And, that could be a 2026 story very easily. That could be something that happens in the short run here for many different reasons. Either Trump gets what he wants from the Fed, or we get that recession and the Fed feels for it. All of that stuff could happen in the not too distant future. So I think to call now the calm before the storm kind of implies that it's calmer now than it is. But this might be something we look back on and think, wow, last July, that was so much easier to figure out than today.
Right.
So we'll see. I started this Substack in 2023 and set up model portfolios. And 2023 was the beginning of a brutal bear market for precious metals miners. So I spent
nice
a year
timing.
I spent a year with like everything I recommended going down, and so a whole long list of red, and but the last year has been as good as the previous year was bad. So now I'm very proud of the precious metals model portfolios in that Substack, because they're basically almost all up. And some of them are up dramatically, and a lot of them are takeover candidates. So I think in the next couple of years, the portfolios I've set up now are going to be shrinking. The prices will be going up, but the number of stocks will be going down as these guys buy each other out. And so, yeah, that's one aspect of the Substack. And the rest is all about resilience, what you can do in your life and with your finances beyond buying gold and silver to make yourself resilient in the face of potential chaos that's coming our way. And there are a ton of things to do. Staying healthy is probably the biggest one, bigger even than finance, because if you're not healthy, you have no ability to roll with punches when things get crazy out there. So that's job number one: stay as healthy as possible. And then how do you manage your relationship with your community and your job, and et cetera, et cetera? There's a lot we should be doing to be ready for a world that takes a few years to sort out, because everything is kind of failing at the same time.
A calm surface can be deceptive. Silver's pause below $40 looks minor, but underneath it is years of compressed energy and unresolved imbalances. What happens when that pressure finally releases? It's not just about metals, it's about trust. In a system where central banks hesitate, political signals grow louder, and inflation stays sticky, confidence is the real currency. And confidence is fragile. The metal markets are hinting at something more profound: a slow erosion of faith in paper promises and a quiet rush toward what can't be printed. So the question isn't whether silver breaks out. The real question is, when it does, who's going to be left trying to catch it on the way up? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.